Hi, welcome to the webinar. Today we're going to talk about how to keep more of the money you make. Now first, before we get started, I just want to make you a promise. Time is our most valuable asset. You and I know it. We can't get it back. Once it's gone, it's gone. And so I'm going to make you the promise that if you stick with me to the end, you're going to learn enough to make your investment of your time in me, which I take very seriously, a good investment. So while we're talking today, I'm going to show you how to save $5,000 to $50,000 in income taxes every year. Now I know that's another bold promise, right? Two promises right off the start. But I am going to show you how to do that. So who am I? Who's this guy making all the promises? Well, I've been a tax strategist and CPA with small businesses for over 20 years. I had a nationally syndicated radio talk show. I talked about tax strategies and savings and investing. My goal is just to help people make as much money as they can and to keep as much of that money as they can. I've also authored a book, Keep Your Money, How to Save $5,000 to $50,000 in Income Taxes. Does that sound familiar, right? So hey, here's my book. And if you go to this email, send me an email, neckercpa@gmail.com. I just want to give you a little extra value. This is a $47 book. I'm going to give it to you absolutely free, just because you came and registered for the webinar. So when you send an email to neckercpa@gmail.com, my assistant will put your email address into a system that's going to send you an automatic login. And when you log in, you'll have access to that. And the nice thing about being able to get that through a login, and this is totally my gift to you, okay, is when you log in, we also can post some other videos that are going to help you save money in the future, and you can access them at any time. You won't get a bunch of emails from us, but go there, and that's my gift to you, okay? So let's talk about two real core strategies. Now, the tax code is huge, so you know that we can't discuss that all in this short time that we have together, but I am going to talk about two core strategies. But out of those core strategies, you're probably going to learn, 8 or 10 little individual tax strategies that you can employ to help you. You see, taxes are very different for everyone. One size doesn't fit all. Everybody has their own goals and what they want to accomplish. So what we want to do is I want to give you the general core strategies here and some of the strategies that underlie those core strategies, and you're going to be able to take tangible stuff home with you today that you're going to say, hey, I can employ this strategy and it's going to save me $5,000, $10,000, $15,000, whatever the number is, okay? Again, your situation is probably different. I should probably say results are not typical, whatever that is, that legal mumbo jumbo. So here's what we're going to talk about. We're going to talk about current tax year planning, okay? So this year, what can you do? And if we're early in the year, what can you do maybe if you haven't filed your taxes to save on last year's taxes as well? That's going to be part of that current year tax planning. And then we're going to talk about long-term planning as well. Because long-term planning, most people think about, oh my gosh, I got to write the check on April 15th, or I pay so much in tax in my quarterlies, whatever it is. Long-term planning really is setting strategies in place that not only help you this year, but as you use them year after year after year after year, they save you money 5, 10, 15, 20,000 or 20 years down the road, right? $20,000, 20 years down the road. So whatever the numbers are, you want to implement a strategy that's not just now, not just instant gratification. We want that, but we also want that long-term strategy, okay? So let's dive in. Let me ask you a simple question. Is it better to pay taxes now or later? Is it a trick question? Yeah, neither, right? Now look, we have an obligation to pay our quote-unquote fair share of taxes. But the reality is we're supposed to be able to, and there's Supreme Court justices that have said this, we're supposed to be able to structure our businesses to pay the least amount of tax allowable by law. Okay? So we're supposed to be able to do that, the least amount allowable by law. So we want to shrink that amount of taxes we pay now and later so we don't pay nearly as much. You see, because wealth is created in the margins. Let's just think about this for a second. If you were going to write a check to Uncle Sam for $20,000 and we were able to implement a strategy that saved you $10,000, that's like found money to you. That's money you were going to write a check to Uncle Sam for anyway that now is back in your pocket. What's that return on investment? I think it's huge, right? Depending on what you might pay in some fees, whatever, it doesn't really matter. At the end of the day, that's found money to you. And that's where true wealth is created. And wealth really buys freedom. That's really what we're talking about, is freedom for you to do what you want, when you want, how you want, and who you want to do it with. So money isn't everything, don't get me wrong, but it sure makes a big difference in the world when it's used in the right ways. So, okay, now I'm off my soapbox. Let's just dive into current tax year planning. So why is this so important? And people say, well, you know what, pay me now, pay me later, I got to pay my taxes. Well, the truth is yes, we talked about that. You do have to pay, but you can structure your business to save more money than you can imagine. Do you realize that people usually don't plan? And what does that do? We overpaid our taxes last year and each and every year. Over $1 billion. How much of that was yours? Right? That's my question. How much of that was yours? Overpay by $1 billion each year. And you know who put that statistic out? The Internal Revenue Service. They know you're overpaying your taxes, but they're still not going to give that money back unless you ask for it, right? Unless you say, oops, I made a mistake, or oh, I should have taken these deductions. They're not going to tell you what you're supposed to do, right? They're going to keep your money. So we want to avoid that by planning. So most of the time, people overpay their tax because they miss a lot of deductions that are out there. Now, I'm not going to be able to talk about all the deductions, but I'm going to talk about some good ones for business owners, and also some employees who work at home and maybe they take some employee deductions on their Schedule A. Some of these deductions work for that too. So a lot of people miss certain deductions. One of them is a home office deduction. And let me back up just a second. Missed deductions. If you're in business for yourself, I'm guessing you think, sleep, eat, drink business, right? All of it. It's you, your business. You never stop thinking about it. Even when you're at the football game, now and then you run into somebody that says, hey, how you doing? Or what do you do? You're always talking about business, right? It's your life. It's your passion. It's what it's supposed to be. That's what it is for me, right? We're always doing business, whether we think it's quote unquote work or not. So my philosophy is if it looks, feels, or smells like business, like a business deduction, then we should be deducting it. Okay, and I'll qualify that. There's some stuff you just by code cannot deduct. But let me tell you something. If you don't take the deduction, you'll never get it. And if you take the deduction and the IRS maybe looks at your tax return, which probably won't happen after today's talk today, if they look at your tax return, you're going to pay the tax you would have paid them anyway, right? Not a bunch of penalties and all of that. Most of the time that stuff goes away in an audit. So it's just going to be the tax you would have owed anyway. So let's talk about the home office deduction. If you use a portion of your home for business, it can be a small portion, it can be a large portion. You get to deduct a whole bunch of different expenses against your business income. Okay, so let's think about that. What is used in your home? Let's just say you have a little corner office. Maybe it's a bedroom, whatever, extra room, and it's 10% of your house, 5% of your house. Whatever else you do, though, if you have a business vehicle and you park it in the garage, now that becomes part of your business square footage, right? If you have filing cabinets or something like that, or you keep supplies, I have contractors for clients, and they keep supplies out in a section of their garage. Now that is also part of your home office deduction. I have real estate professional clients and they have signs and things like that. All that space, anything used for business, and it can include a bathroom as well, okay? All that is part of your home office deduction. So let's talk about how you take it. It's based on square feet. So I'm going to keep the math super simple, okay? I'm going to use 1,000 square foot home. All right, and I'm going to say we have 100 square feet of office space. All right, that's a 10 by 10 room. All right, now that's 10% of the home. But if we also park our car in the garage, that almost doubles that, right? Because a vehicle will definitely take up a 10 by 10 spot in the garage. So if we look at that, now we've just doubled our square footage percent. Now we're at 20%, okay? This has to be a legitimate area, all right? And I will also tell you, I've never seen the IRS show up at your house to measure your square footage. So what do you get to deduct? You get to deduct your utilities. You get to deduct, if you rent, you get to deduct your rent, gardener, repairs, maintenance. If you own your home, you can depreciate it. I usually dissuade people from doing this because once you start depreciating it, as you know or maybe not know, if you sell your personal residence, there's a $250,000 exclusion if you're single or a $500,000 exclusion if you're married. And if you depreciate part of that house as part of your home office, you have to recapture that amount you depreciated and pay tax on it. I don't want to confuse you. I just usually dissuade that. Now, depending on how you're structured, you can also deduct property taxes if you own your home, mortgage interest, insurance, all of that kind of stuff too. There's certain cases where you want to, and there's certain cases where you don't. So we'll talk about that a little bit later. So this is a great deduction for people that generally, if you add up all those expenses, typically you're looking at 20% or 15% of your total home costs winds up being $10,000 to $15,000 on your deduction, okay? So it saves you a bunch of money in tax. Next one is business travel. Well, what constitutes business travel? Remember, if it looks, feels, or smells like business, you should be thinking about deducting it. Can you justify that trip back to see your folks? And yes, part of that's personal, part of it's business, right? We wouldn't deduct the whole thing in that case, but you still get a bunch of that as long as you do some business while you're gone, okay? It's all about your intention. The IRS looks at intention a lot. So what are some business travel deductions? Well, your airfare, your lodging, wherever you're staying, your meals, transportation, that's a rental car, or cabs, or buses, certain entertainment with clients or potential clients and things like that. That all lumps into there. And then everybody says, well, what about my annual business trip? My annual business meeting, can I deduct that? Well, the answer is absolutely. And they say, well, how about if I go to Mexico and have it? That's where it gets just a little sketchy. And I'm not saying you cannot deduct foreign travel, because you can, right? You just have to have a more stringent documentation of why you needed to have the meeting in Mexico versus Southern California or something like that, right? You can see that difference. So you can deduct foreign travel. So business owners, I say you should be taking advantage of being in business for yourself, okay? And part of that is, as a business owner, you make your money, you deduct your life, and you pay taxes on what's left over. And I really want you to get that. So I'm going to say it one more time. You make your money, you deduct your entire life, everything that's truly deductible, and then you pay taxes on what's left over. The difference being is if you're an employee, you make money, they take all the taxes out first, and you live on what's left, right? It's one of the reasons we're in business for ourselves, to take advantage of this stuff. So use it wisely, don't abuse it, but this is a very big category that can be justified for some pretty good deductions. HSA plans, health savings accounts. Now these have transpired over the last couple of decades, my entire career. HSAs, there used to be MSAs, and they've made laws to where, gosh, if you put money in and didn't use it, you lost it. If you put money in and you had to use it for certain things, and then they gave some exceptions. Anyway, it used to be really convoluted. Now it's super simple. It's not just for self-employed people. And an HSA plan really gives you a pre-tax deduction. Okay? So what you get to do is you put money into this plan and you get to use it for your health and well-being, right? You cannot use it to pay insurance premiums, but you can use it for all your out-of-pocket medical, dental, prescriptions, all of that kind of stuff. The other thing is if you don't use it, it grows just like an IRA, right? And you can take that money out later and use it in retirement or for college or something like that. And when you take that money out after you're 59 and a half, it's more like a retirement plan. So you can use HSA plans. The power of it's like this. You put $6,500 a year into a family plan, and there's different limitations. I'm not going to go over them all today. You put $6,500 in there because you put it in pre-tax, right? You got a deduction for it on the front page of your tax return. That's like having over $9,000 of purchasing power. As accountants, when we look at a tax return, there's 2 pages of your 1040 before you get all the other schedules. And at the bottom of the first page says adjusted gross income. What we call that, any deductions you take before you get to adjusted gross income, we call that an above the line deduction. It's the best there is. If you can reduce that number, it's the best deduction there is, right? Everything else is below the line deductions, and they're good, but they're not as good, right? So this gives you about $9,000 of purchasing power. You'd have to make $9,000 and then pay the tax in order to spend $6,500 if you didn't use one of these plans. It's a great plan. I recommend them highly. Okay, retirement plans. Now this is a biggie, right? Because almost always when I ask people what their goals are, they start shooting and talking about retirement plans, right? They say, this is what I'm shooting for. This is what I want to accomplish. I want to retire at this date. And then I ask them what retirement means to you. I mean, does that mean sit on the couch and eat bonbons? Does it mean do something different because you hate what you do? Or does it mean I'm going to always do something that I'm doing now because I love what I do? I just don't want to do it at this level. Whatever it is, there's a lot of different retirement plans. And so it really comes into saying, is it a before tax plan or an after tax plan? What does that mean? So let's look at the buckets here. Very simplified, there's 3 ways to invest your money. There's what I call tax today, tax tomorrow, and tax never. So what's in that tax today bucket? That's like your savings account. I know we don't talk about those very much anymore because interest rates are horrible, right? But also, if you open just a brokerage account in your name, it's not an IRA or tax-deferred vehicle. It's just a brokerage account you open. That's tax today, right? You put after-tax dollars in there, and then you pay tax on all your gains. So each and every year, Uncle Sam's out there taking a haircut. Boom, give me some of that. Oh, you made a little money. Give me some of that, right? Then there's the tax tomorrow bucket. It's a little bit better, right? We think, and it truly is, but really you're kind of kicking the can on down the road. No pun intended. So what that is that's like a traditional IRA and things like that. We're going to talk about these in detail, but you get a tax deduction now, so it feels really, really good. I put $10,000 in here. I saved $3,000 in taxes. All right, I made $3,000. Uncle Sam's given me $3,000. Feels really good. That money then grows tax-free, and when you pull it out of that vehicle, whatever one it is that we're going to talk about, then you're taxed on it. And the illusion, and I say illusion because it hasn't happened for a lot of my clients, everybody says, well, I'll be in a lower tax bracket when I'm not working anymore and I'm in retirement. And they finally realize that they've been super successful throughout their life and they're not in a lower tax bracket. And so that money, when they pull it out, is now, again, heavily taxed. So it's not good or bad, it's just different, right? And then there's the tax never bucket. And that's not quite true, but here's what happens with that. We're going to talk about these vehicles too. It's like a Roth IRA or a 7702 plan. What happens there is you put after-tax dollars in, but then it grows tax-free and you pull it out tax-free, never to be taxed again. Okay, you paid tax on it once, never to be taxed again. All those gains are for you. I like to use the analogy of a farmer, right? So a farmer has a bag of seed before he goes and plants his field, and Uncle Sam says, you know what, I'm going to give you those seeds for free. You just go plant them, okay? But when you harvest the field, I'm going to tax part of your harvest, okay? That's the tax tomorrow bucket. Tax never bucket is Farmer's got his bag of seeds. Uncle Sam says, look, I want a few of your seeds, okay? But whatever your harvest grows into, it's yours to keep, never to be taxed again. That's the tax never bucket, okay? So you see the different ideologies between each of those. Now let's talk about what's in each of them. So your most familiar retirement plans, your traditional IRA, right? That's in the tax tomorrow bucket. The Roth IRA, tax never bucket. Now, I want to say something here, and this is one of those things you want to write down. The Roth IRA, if you make too much money, right, over $160,000 married filing joint, I think it is now, you cannot contribute to a Roth IRA. But there's a back door. So this is what I want you to write down. You can always make an IRA contribution. Now, it may not be deductible depending on your income level, but you can always make a traditional IRA contribution. All right, let's just say you get a tax deduction for it. The following year, you can roll that traditional IRA into a Roth IRA. There used to be limits on that, income limits. Now there's not, right? And so then you'd pay the tax. Well, you save the tax this year, you paid the tax next year. It's a net zero, right? But you've just funded a Roth IRA. Now that money that grows in there, never to be taxed again. I call it a backdoor Roth IRA. Okay, it's a great tool. Also, simple plans. Some people still use those. They're really good for depending on your income level and what your business is. That's a tax tomorrow. SEP plans, if you're old enough to remember the KEOs, I am. Those are tax tomorrow plans. And then your 401ks are tax tomorrow plans. Now there's a Roth portion in a 401k that's really cool that's also in that tax never bucket. All right. And then a solo 401k. All right. Again, tax tomorrow. So these are kind of what most people, whether you're an employee or whether you're a business owner, use as retirement plans. So let's talk about the tax never ones, because I like this strategy for a couple of reasons. First of all, we might not get that current year tax deduction, break, feel good, instant gratification of today, but the power. I'll give you an example. I had a client in my office the other day, and he's done very, very well in his business, and he's worked super hard. He came from nothing, but he came in, and he's in his retirement years, and his traditional IRA, because that's what his guy told him to do, is worth about $3 million. And before you say, oh, poor him, right? That's a nice nest egg he built. He built that over about 45 years, okay? But now, with his income, he wants to pull out $300,000 of that. He only needs $200,000 a year to live, right? And so if he only needed $200,000 a year to live, that $3 million would last him a long, long time. But the reality is he has to pull out $300,000 just to net his $200,000. So now that's a totally different number when you start thinking about what am I going to make on my retirement plan, even though it's $3 million, right? You do the math. It's all simple math, whatever your numbers are. He's in a very different retirement situation than he thought he'd be, because now we have to deal with taxes in retirement. Okay, that's why I love a Roth IRA, and if you make too much money, I still recommend putting it into a traditional and rolling it into a Roth. The more you can get into a Roth type environment, awesome. And then there's the 7702 plan. Really what this is, that's code section 7702. And what that covers is cash value life insurance. And before you go, oh, life insurance, that's horrible. This is different, right? Most people, and quite frankly, most insurance salesmen, what they do is they say, look, the higher the premium I get you to pay, right, the higher the death benefit and all of that, the more money I make. So what do you think they're going to do, right? They're just going to say, hey, why not get the $1 million policy instead of $500,000 policy? You can afford it. Well, that's not what 7702 is all about. 7702 actually covers the opposite of that. It says, how much money can I put into a policy and only buy the minimum amount of death benefit? Think about that for a second. Most people tell you, look, I'm going to sell you a permanent life insurance policy, put $5,000 a year in, or whatever the number is, right? And there's only $3,000 worth of insurance cost. And so that $2,000 is going to grow, and pretty soon you won't have to make premium payments anymore. Sounds great, right? Right. Not so much. Here's what 7702 is about. It's like, how much money if I was going to put $50,000 a year away, or whatever the number is. It doesn't have to be that high. It can be a lot higher than that. What's the minimum amount of death benefit that I have to buy to put $50,000 in a tax never bucket with guaranteed no loss and upside potential? I mean, some of the plans out there now, the way they're structured, give you zero risk and all the upside potential. But they have to be structured right, okay? But this kind of planning right here would have alleviated my client with the big IRA, right? Alleviated his need, because he'd have $3 million in a 7702 plan, for example, never to pay tax on that again. Now how long does that $3 million last when it's still growing and it's guaranteed floor, so you cannot lose the money in the investment account? It's pretty huge. So, oh gosh, I think I talked about all this already, right? There's no income limitation in a 7702 plan. So where the Roth has the limitations and you can only put $5,500 away, if you make $200,000 or $500,000 or $50,000, you can implement a 7702 plan, right? So this all grows tax-free. You pull it out tax-free. There's no age restrictions like on the retirement plans. You have to be 59 and a half before you can pull it out. It's super easy to access funds even before you're 59 and a half, because there's no age restriction, right? No penalty. So now let's talk about some long-term planning. And some of that kind of was. But I want to talk to you about a C Corp strategy. See, most of my clients are small business owners, and they work very, very hard for their money, and they need to know how to structure their businesses. And what most CPAs don't tell them about are C corporations. Now, they're not the greatest thing since sliced bread. They have their pluses and minuses just like everything else. So what I want to do, one of the most common questions I get is, what kind of entity should I have? So I'm going to walk you through each one. I'm going to put a tax situation with it, and I'm going to show you what I think a lot of these strategies are. So what do most people do? You'd be surprised. Most people still have a sole proprietorship. And if you're on this webinar and you have a sole proprietorship, that's nothing against you. Sometimes they work really, really well. Here's the challenge with them. Most people use them because they're easy to set up, right? Uncle Sam makes it easy to set up a sole proprietorship. Most of the time, all you have to do is say, look, I'm in business. I'm in business, and here we go. The reason they're easy, sole proprietors pay the absolute highest amount of tax possible, okay? That's why I don't like them. And they have no liability protection, none, okay? You need some sort of a legal ownership to get some sort of liability protection against lawsuits, right? So let's walk through a little scenario. Now I'm going to keep all of these the same because I just want everybody to compare apples to apples here, okay? And I got my bucket here, and so that we got this sole proprietorship. And we're going to say that we have $300,000 of bottom line income. So, maybe you made $400,000, had $100,000 in expenses, whatever the numbers are. $300,000 bottom line income. We're going to pay self-employment tax on the first $118,500 of that, right? That's the Social Security portion. Medicare tax on all of it. So our SE tax on that $300,000 of income is $19,700. Self-employment taxes, okay? That's just because you're self-employed. You pay that. Where's that money go? Well, it goes to Social Security. Now, some of you, I don't know you and your personal situation. Some of you may want your money to go to Social Security. I can tell you we've studied it over and over and over again for various clients. And if you take that money and not pay it into Social Security and put it to work for you, you're probably a better steward of your money than Social Security or Congress is, right? So the strategy here is, strategies upcoming are going to be, how do we save some of that self-employment tax? It's not a good investment for you. And I'm also going to keep this just an average amount of deductions, say Schedule A deductions, you know, exemptions, whatever. We're going to use $22,000. That gives you a taxable income of $278,000, right? 300 minus the 22. Tax on that, and these are like married filing joint rates with 2.2 kids, right? $65,700. That's not even including any state taxes. Okay, this is all federal. So you got $65,700 plus $19,700, $85,400 of total tax on $300,000 worth of income. That's insane, right? And as your income grows up, I have people who are paying, you know, more than 50% of their last few dollars in tax. It's insane. They come to me and they say, what can I do? I'm paying over 50% in tax. And you have to employ some strategies. You have to put some planning in there. So let's talk about that. Then everybody says, well, hey, I'm going to set up an LLC. Why do they say that? Well, because they heard their buddy say, hey, I got an LLC and I don't pay anything in tax, right? And that's a crazy story, because so many people say, why doesn't my buddy pay any money in tax and he has an LLC? And the chances are is maybe he's not making any money. But let's talk about LLCs. First of all, an LLC is a legal bucket, right? It gives you liability protection, limited liability, hence the name, okay? They started in like 1978 in Wyoming, was the first state to have a limited liability company, and they really became popular in the 90s. The challenges with an LLC is the IRS, started in 78, they still don't know how to treat them, right? So you have to choose how you want it to be treated. So you don't get any tax savings. It's just like a sole proprietorship unless you elect to get taxed as an S Corp or you elect to be taxed as a C Corp, which we're going to talk about next, okay? Remember, LLCs can be taxed as any entity. An LLC can still be a sole proprietorship. If you don't make the election to be an S or a C, you're going to be a sole proprietorship, or if there's more than one owner, you're going to be a partnership, okay? So an LLC can be any of these for tax purposes. So let's talk about the S Corp strategy. Some people say, well, how's that work? Well, it's what a lot of people do, okay? And if you're still a sole proprietor, you should probably think about it. If you have an S Corp, I'm going to give you some more strategies. But what a lot of people do is say, hey, we're going to set up an S Corp and we're going to save some SE tax. And I'll be straight, other than the liability protection, saving that $19,700 or some of it in SE tax is one of the sole purposes of an S Corp, okay, when it comes to tax savings. So these used to be really awesome. But back in 1986, they lost a lot of their tax advantages, okay, when Congress changed the laws. That doesn't mean they're not great. It's just they're not quite as good as they used to be back in the quote-unquote good old days. All right, so an S Corp, it doesn't pay any tax unless you're in states that impose like a franchise tax, but that's a state tax. It's not federal, and we're going to talk about federal here. What happens is you file a separate tax return, but that income flows through onto your personal tax return, and the owners pay at their personal tax return rates. Okay, a lot of items like health insurance and stuff like that flows through separately, so they're not, even though you were paid them through your S Corp, they might not get deducted there. They get deducted separately on your personal tax return. So now let's look at this tax savings, right? Because this is really what we're talking about. So how do we save money? $300,000 of income, just like the sole proprietorship. Here's where we save the money. The IRS says that you have to pay yourself a reasonable wage. Now let me caution you here, because there's a lot of CPAs out there that will tell you, you don't need an S Corp because we're going to have to pay it all out to you in wages anyway. That is just, as my grandma would say, hogwash. Okay, you don't have to pay all your income out in wages. What you do have to pay is a reasonable wage, and now the IRS has left that completely open. Now, I've had ranching clients who detest paying taxes, who they wanted their wage on $300,000 to be $3,000 for the year. That's not very much, is it? And I've had real estate professionals who've paid themselves $50,000 a year for decades, okay, decades, and that's always been reasonable. So that's why I use $50,000. I'm not really comfortable with three, but the thing is if your income drops, you have a right to pay yourself less of a wage. So when you have shorter years than you planned on, you can pay yourself less of a wage. And when you have larger years, you don't necessarily have to pay yourself more. All right? So our net income from the S Corp is $250,000. So we're still making $300,000, right? $250,000 from the S Corp, $50,000 in wages. So we still have the same $300,000 of income. We have our $22,000 deductions, same as the last one. So our taxable income doesn't change, right? It's still $278,000. That's why we're comparing apples to apples. Okay, so $278,000, same income tax, $65,700, right? But here's the bonus. We only pay self-employment tax on the wages. So now we've taken our self-employment tax to only $7,650. So our total tax is still high, don't get me wrong, $73,000, but we saved $12,000. That's money that you were going to write a check to Uncle Sam for anyway, that now just went back in your pocket. That's $1,000 a month. That can be a difference in retirement over a period of time, right? Wealth is created in the margins. So now let's talk about C Corps. A lot of people don't use C Corps. But the benefit of a C Corp is, first, it pays its own tax. It's not subject to your personal income tax return rate, okay? And in a C Corp, these tax laws haven't changed in a long, long time. They've got a lot more and a lot better deductions, okay? So here's what's awesome, and it's going to get even more awesome. Here's how it pays its own tax. On the first $50,000 of income, 15%. Okay, so you can see you're paying tax at 35%, and now all of a sudden 50,000 of that tax is only taxed at 15. You just saved 10 grand, right? Huge. Okay. Now currently, and we'll talk about this, the next $25,000 of income is at 25%, and the next 25 at 34, and then it goes up from there, okay? It stays at 34. That's the top marginal rate in a C Corp right now. So what I want you to get, though, is this. There's tax benefits that we're going to talk about in a minute, but I want to focus on this for a moment. With our current administration, love them or hate them, it doesn't really matter, but the easiest way that he wants to create jobs and tax savings in America is right here in the C Corp environment. So instead of that being $0 to $50,000 at 15%, it's $0 to whatever you make in your C Corp is taxed at 15%. That could be a potential huge windfall for small business. We'll show you here in a minute. So I have two columns here, one on the left, one on the right. I like to use the C Corporation in addition to an S corporation for a couple of reasons, okay? First of all, C corporations are a little harder to get cash out of without double taxation, so we'll talk about how to avoid that. An S corp and a C corp work very well hand in hand. So on the left-hand side is our S corp, okay? On the right-hand side is our C corp. So we're going to shift $100,000 out of our S Corp into our C Corp. Okay, how are we going to do that? Maybe it's marketing expense. Maybe if you're a contractor, your C Corp buys all your materials and takes a fee for it. Whatever the justified business purpose of that C Corp is, and I can walk you through some of those strategies, we're going to figure out how to shift $100,000 worth of income over there. Now you have to pay yourself a wage. We're paying the same amount of wage, $50,000. We're just paying $25,000 from each entity, okay? So you can see our net. So at the bottom line, I'm just going to jump down to it. Our taxable income in the C Corp is now 75. Our taxable income personally is only 197. Okay, so now we've cut our tax to $63,400 on all of our income. On that same $300,000 worth of income, now we're only paying $63,400 in tax. And again, this is just federal. Okay, that's a $22,000 tax savings. That's huge. So the other thing we need to talk about in C Corps is the state side, okay? We'll talk about that. So what really is the C Corp strategy? Really, it's all about shifting your income from your high personal rate to a lower tax bracket. Now, if we go back up there to that tax savings, these brackets here, if that on all your income is now 15%, we don't ever hit the 25 and 34. Oh my goodness, think about what that number could be then. That could be huge. So when you have that extra set of tax brackets, you want to shift from the high and go to the low, okay? What are some other income shifting strategies? Well, have you ever thought about paying your kids? Some people don't think about that, but you can actually pay your kids a salary. They can file their own tax return. You still get to claim them as a dependent. If you're in a super high tax bracket, you might not want to claim them because you don't get any benefit and they can claim themselves anyway. That's a different strategy. But just simply paying your kids to clean up the office, clean up the shop, set signs up if you're a realtor, whatever you want them to do. Show them your business, work with them, hang out with them, right? Make them pick up their shoes and their clothes and all of that stuff too is part of the deal. But when you pay your kids, you're taking income out of your high tax bracket and you're shifting it down to your kids' lower tax bracket. So the tax brackets for personal, they start at 0. Then it goes to 10, then it goes to 15, 25, 28, 33, on up, okay? So if you're in the higher tax bracket and you pay your kids, you can pay them $6,300 this year and they'll pay 0 tax. So if you have 2 kids and you pay $12,000 out in wages, you just save $4,000, okay? Because that came out of your tax bracket at a high rate as a deduction, and it went into theirs at 0. Okay? If you paid them $10,000, you'd have about $4,000 in the 10% tax bracket. And you got a $20,000 deduction now with 2 kids, and they're paying about $800 in tax. How huge is that? Right? That's a great strategy, and if you pay them out of a C Corp, there's some other advantages we'll talk about in a little bit. Also in a C Corp, an S Corp and your sole proprietors, all of those, they have the same year end. December 31st, everybody's year ends, and you pay taxes either in March if you're a S Corp or in April if you're a individual. We all know that, right? So what about a C Corp? A C Corp can choose a fiscal year end, and you're thinking, well, why would that be powerful? Well, think about this. If your S Corp is your business and you have a December 31st year end and you had a really good income year, what if you could take part of that income and write a check over to your C Corporation in the month of December? Okay? And you get the deduction this year and save taxes. When do you have to pay tax on that C Corp? Well, if it has a November 30th year end, you paid them in the first month of their calendar year or of their fiscal year. So they don't have to pay tax on that for another 14 months. So now you've also shifted that tax burden to a future date. That's the power of the fiscal year end. And then that money can compound. That money that you were going to write to Uncle Sam now is now taxed at a lower rate, and you get to compound it. Isn't that beautiful? My gosh. Okay, let's talk about more and better deductions. Medical deductions, Section 105. I put these in here because sometimes CPAs say, well, you can't deduct medical. And well, there's the code section. Section 105, you can deduct medical. And here's the difference. When you're an individual trying to deduct medical expenses, some people don't even keep track of them really because they're never above their 10% of AGI, adjusted gross income, that bottom line number on the front page we talked about, right? There's this huge limit at the individual level on what you can deduct. Those same medical deductions paid in a C corporation for the employee, which is you because you're getting a wage, 100% deductible. 100% deductible. So if you had $10,000 or $20,000 in medical expenses, out-of-pocket medical, that kind of stuff, paid through a C Corp as part of this benefit plan, 100% deductible. That can be huge, right? You're not really getting benefit for the deduction, or most people aren't on the individual level. Now you're getting the benefit for the deduction. Here's what I was talking about paying your kids. Section 127 is education plans. You can pay up to $5,250 per year per employee for education expenses. So whether you're sending them to a seminar or maybe a college class or some sort of private education, some sort of specialized training, you can pay $5,250 out of your C Corp, 100% deductible. 100% deductible. Awesome stuff. Okay. Section 125, cafeteria plans. You can use these now in other types of environments too. They're not just tied to a C corporation, okay? A cafeteria plan goes back to like that HSA concept, okay? Where, look, I put money in and I get a deduction for it, and then I get to use that money to pay expenses. So you put in the HSA, it was $6,500. It's like $9,000. This is the same thing. You get to put that money in pre-tax. Before taxes, it's not ever going to be taxed. You pay that money out for child care, things like that, through your cafeteria plan. And it's basically like saving 40%. Okay, you put $6,000 in, gives you $10,000 worth of buying power. Awesome stuff. Now, let's talk about state taxes just briefly. And I don't know your personal situation. I'd like to get to know it. Maybe I can give you some help with this. But state taxes in some states are astronomical. I think you would agree with me, depending on where you live. State taxes, well, in California, I think is the highest. 13% is their top bracket, okay? So with a C Corp, depending on what it's doing for you, it can be set up anywhere in the country. It doesn't necessarily have to be set up in the state where you operate. Especially a lot of online businesses, they're not set up in the states because they can be housed anywhere. Okay? So a lot of times a C corporation can save you a lot of money in state taxes. C corps also give you liability protection. It's that legal bucket that goes around your business. Okay? So why isn't everybody doing this, Vern? Gosh, these have been around forever, right? Well, here's the reality. A lot of people say, look, they're complicated. Who says this? CPAs. Remember the $1 billion Americans overpay every year? Do you know that 60% of that are returns prepared by CPAs or tax professionals? So what does that tell you? That tells you that a lot of CPAs also don't know everything they need to help you with your personal situation. And I'm not bagging on my industry at all. The challenge is that most of them are so busy that they don't spend any individual time with you, right? What are your goals? What are you trying to accomplish? So when you come to them with an idea like, oh, I want to set up a C corporation and save some taxes and use a fiscal year end and da-da-da-da. They go, oh, that's complicated, right? Oh, when am I going to find time to do all of that, right? C corps aren't complicated. I'm going to show you how simple they are here in just a second. Then the other thing is some people say, well, look, there's double taxation, right? Because if I take money out of my C Corp, I have to take it as a dividend, and I got to pay tax on the dividend, and the C Corp doesn't get a deduction. That's the whole double taxation myth, okay? It's real, don't get me wrong. It's just there are so many ways to get your money out of your C Corporation. You shouldn't have to pay a dividend. For one client, we actually paid him a huge dividend last year because the way their income was structured, they paid zero tax on it anyway. Right? So double taxation is blown way out of proportion. Do you have to plan for it? Absolutely you do. Should it stop you from saving tens and 20 and hundreds of thousands of dollars in tax by maybe using a C Corp, depending on where these rates go? No, absolutely not. So how do you set this up? Well, first of all, you pick your venue. What state do you want it to be in? Now, that's a good question because a lot depends on the state you're in. If you're already in a tax-free state, there's no reason to use a different one, right? Some people say, oh, I need to have it in Delaware. Most states that don't have taxes in the U.S., income taxes, have amazing laws anyway, so you don't need to shift it over to Delaware or anything like that, right? But if you're in one of those high tax states and you have a legitimate reason to have a separate business, maybe it runs your marketing, something like that, doesn't have to be housed in your state, doesn't have employees in your state, maybe you can choose a different state and save a bunch of state taxes. Anyway, choose your venue. You file articles of incorporation. That gets filed with the Secretary of State. That's what they stamp that and they say, boom, you are a corporation. Okay? You choose your fiscal year end. And when you choose your fiscal year end, you're going to create bylaws, and then you get an employer ID number. Okay? Woo! And once you have that, you're set, right? So that's how you implement that C Corp strategy. Now I know I went through this fast. You know what? For most people, taxes are super, super boring, and I get it. I hope you stayed with me this long, right? Here's the deal. Saving taxes, though, isn't boring, all right? Putting money in your pocket to achieve your goals, that's not boring, right? That's the strategies. That's what I get worked up about. You see, these are just a few of the tax strategies that we have. It's like a tip of the iceberg. There's a lot of other types of strategies. There's other retirement vehicles. There's other strategies that you can use LLCs to, well, I'll just tell you, cut your income tax in half if it's used properly in a structure that I can show you. So here's the challenge, is there's all these tools out there. And I know some of these tools you can employ and save thousands of dollars a year, maybe even more, okay? What you need, though, is a strategy that works for your business. Everybody's different. Nobody's situation is the same. You also need a strategy that's flexible. A lot of times people will set something up and it's not flexible at all. You can't change it, you can't modify it, and that's not the kind of strategy that works for most people. You see, these strategies are supposed to give you your freedom, right? They're supposed to save you money. They're not supposed to take all your time and be complicated. They need to be simple strategies that save you money because they're effective, all right? So these are a few of those tools. So let me tell you what I've got for you, okay? I'd like to help you create your plan, all right? Create an individualized plan for you. So here's how this works. If you go to save50kintax.com/strategy, okay, when we create this plan for you, it's tailored exactly to what you need it to be. So here's how my system works. You go here, save50kintax.com/strategy. I ask you to leave a show up deposit. Now, why is that? It's because I do a lot of webinars and I would have thousands of people that wanted to talk to me all the time. And I just want to know that you have a vested interest in learning a tax strategy that I help create for you, okay? Look, it's totally refundable if you want it back. If at the end of the time we create a plan for you and all of that, you don't feel you've received any value at all, then I'll totally give you your money back. I'm not here to make money on not giving value for you, okay? But I do want you to have a vested interest and show up, because maybe you've noticed this. When you pay for something, you pay better attention. The more you pay, the better attention you pay. All right, and it's not much. It's $500, right? And again, if you don't get any value from it, whatever we do together, I will totally refund it. I don't want that if I'm not giving you value. So you leave your show up deposit. Carol calls you. That's my assistant. She's been with me, gosh, almost 17 years. She calls you to set up a time to talk, okay? And we're going to get on the phone. And when we get on the phone together, here's what we're going to talk about. I'm going to learn more about your business. You're going to tell me some numbers. Maybe we'll share some tax information. Probably will, but I want to learn about your business, how it works, what drives you in your business, where you're headed, what you've been paying in tax, what's holding you back. See, it's not just about taxes. It's about being able to show you what would be better for you in a lot of areas of your business. I just want to help you, okay? So I'm going to ask you a lot of questions about your business. I want to learn what that is. Then I'm going to ask you a lot of questions about your goals. I would never implement a tax strategy for somebody not based on the long term. It just doesn't make sense, right? So if the strategies that we implement aren't complementing and help you achieve your goals faster, what good are they, right? Save a few bucks here and there. That's a distraction, right? So we want to make sure that any strategies we employ with your business or we create for you, whether we implement them or not, that they're in alignment with your goals. I'm going to find out where you are now. I have your goals. Now I know where you're going. And I can say, okay, if we do X, Y, and Z, if we implement this strategy and this strategy and this strategy, we can get you from A to B, from where you are now to where you want to be in X number of years, right? That's what's important. That's when all this stuff comes together and says, boom, yeah, I can save thousands and tens of thousands and sometimes hundreds of thousands of dollars in taxes, but it's going to help me achieve my goals even faster. Okay, so we're going to create a strategy right there on the phone. See, I've got all these tools in my tool belt. So once I have that conversation with you, we're going to create a strategy that works for you. See, this plan is going to be absolutely tailored for you. I'm going to know more about you in a few minutes than probably many of your advisors already know, okay? I'm going to give you a plan that you can implement, right? I guarantee it'll save you, and I know that's a big word, right? Thousands of dollars, right? Thousands of dollars, and help you get your freedom back. So that's really all we want to do. We want to create a plan that says, hey, this is going to help you be more successful. This is going to save you money. And then basically after we create that, one of three things will happen. Look, you're going to love the plan. I know you're going to love the plan. And maybe you say, you know what, Vern, I've had my CPA for 40 years or 20 years or 10 years, whatever the number is. I'd like him to implement it. Thank you very much. And I'm going to say, perfect. Did you get value out of what we talked about in this strategy? Do you think this is going to save you money? If you say absolutely, then I'm going to give you the strategy. You're going to take that, and you will have paid me a mere $500 to save you potentially hundreds of thousands of dollars in taxes, okay? And I'm going to be okay with that. If you say, no, Vern, I didn't get value out of it, I'm going to give you your money back, okay? Again, it's your choice whether you decide. You decide the value. I'm not going to decide the value. Now, sometimes we may decide we're not a good fit for each other. You know, sometimes it's personality, sometimes it doesn't really happen very often, but sometimes I just get one of those feelings that, you know what, maybe we shouldn't work together. I've had that happen with people in a couple of industries that it just didn't seem like they were being as honest as I needed them to be. So we just decide we're not a good fit. I'll give you your money back and go on down the road, right? The other thing is though what usually happens is a lot of people say, look, I love this plan. I don't know why anybody didn't bring this to me before. And you say, hey, I got a lot of value out of this and I'd like you to help me implement it. And then we're going to implement it with you, okay? And here's what that looks like. Then you become a client. And I absolutely love my clients. You see, because what I see myself as is we've got their goals, we've got their plan, we've got their strategy, we know where they are now and where they want to go. And I see them as the owner of an NFL team, and I'm their financial quarterback. They say, this is the plan and where we want to go. And I say, let me throw the passes, right? So we're going to help you implement all the strategies in the plan. We prepare all your income tax forms, individual, kids if we need to, right? Businesses, corps, S corps, whatever it is, whatever the plan entails, we prepare all your income tax forms. The other thing is we talk on a monthly basis. We have a scheduled time to talk. You can call me anytime. But we have a scheduled time to talk every month. Sometimes those calls are 15 minutes, sometimes they're an hour. Sometimes you say, hey, I'm good, I'll talk to you next month. It doesn't really matter. What matters though is that we're always talking and in communication about staying on track with the goals, with your financial plan. Your advisor gets tied into this, your financial advisor. We pull all these people in and we bring it all together as one team. And I quarterback that team for you. So you got one person to go to say, hey, what should we do? How should we do this? And then we work it out with your other advisors. It is awesome. It takes so much off of your plate, and we get to help you in that. And it's so fulfilling and rewarding for me. The bottom line is we handle all of this so you can focus on income. So that's what it's like to be a client of ours. And I truly love that. So here's what you need to do next. Look, just go to save50kintax.com/strategy. There's a form there, kind of outlines what we're going to do. Talks about the deposit. You click yes, I want to do this. And then you go fill out the form with your name, your information, your credit card info, and all of that. Again, if I don't give you value, I'm going to give you your money back. There's no risk to you. I don't want your $500 if you didn't get any value from me. See, on this webinar right here, I wanted to make sure that if you spent the amount of time you're spending with me, that you could take something away. One of those nuggets, just one of those nuggets in there could save you $4,000 to $5,000, right? That can happen over and over and over again. It can happen 10x, 20x. I love implementing strategies that work for my clients. We've saved clients $10,000, $20,000, $30,000. This last year we implemented a strategy for a client that sold his business. It saved him $600,000 in taxes, right? We've got the full gamut. I just want to be able to have the opportunity to give you a plan, whether you become a client of mine or not. I want to give you a plan that's going to help you achieve your goals faster. It's going to save you tens, if not hundreds of thousands of dollars in taxes and show you how to advance and achieve your goals faster. So go to save50kintax.com/strategy, leave your deposit, and let's talk. Also, don't forget, I'll give you that book as long as you email that email address for me, okay? Thank you so much for your time. I hope this was super beneficial for you. You may have some questions. I can answer any personal questions that you have about your personal situation in that talk. Again, you decide what the value is. If you don't have any value, you say I didn't get any value, you decide. I'll give you your money back. But let me create a plan for you that's going to work well. I look forward to seeing you on the other side. Thank you so much for your time. God bless.